Today, we're going to demystify two of the biggest names in the investment game, stocks and bonds. If you've ever felt like financial talk is a totally different language, don't worry, you're in the right place. We're going to break it all down. So let's just jump right in. What is the real difference between a stock and a bond? It sounds complicated, but I promise it's not. By the time we're done here, you'll get it, and you'll see how these two things can work together for your financial future.
Okay, but before we get into the nitty-gritty of stocks and bonds, we got to start at square one. We need to talk about where you even put these things, about building your investment foundation.
And that foundation, well, it starts with what's called your portfolio. It's a fancy word for something pretty simple. It's just all of your investment accounts, all in one place. The best way to picture it, just think of it as your financial basket. This is the basket that's going to hold everything.
Now, you've definitely heard the old saying, don't put all your eggs in one basket. That's exactly what diversification is all about. It's this incredibly powerful idea of spreading your money around. Why? Because you never know what the economy is going to do, and this way you soften the blow if one of your investments takes a hit. It's a really key strategy for managing risk.
All right, so our basket is ready. Let's start putting some things in it. First up, stocks. You can think of stocks as the engine of your portfolio. They're what you use to really drive growth.
So, what is a stock, really? When you get down to it, it's just a tiny, tiny piece of a company. When you buy a share of, say, Apple or Amazon, you're not just buying a product. You're actually buying a little slice of ownership in the whole business. You become a part owner.
Of course, not all stocks are the same. They come in all different flavors. You've got different styles, like high-flying growth companies versus more stable value companies. You've got different sizes. Cap is just short for market capitalization, or how much a company is worth. So you have the giant large caps, and then the smaller mid and small caps. And, of course, stocks from the US versus all over the world. All these different types, they're your tools for that diversification we were just talking about.
Now let's talk about the other side of the coin. If stocks are that growth engine, then bonds, well, bonds are the foundation. They're all about stability.
So, what is a bond? It's another type of investment, but it works in a completely different way. A bond is basically just a loan. Seriously, that's it. Instead of a big company or even the government going to a bank, they can borrow money from investors, like you. When you buy a bond, you are the lender.
And how it works is super straightforward. 1, you loan out your money. 2, they pay you regular interest for letting them borrow it, kind of like a thank you. And 3, when the loan's term is over, you get your original money, the principal, back. That's the whole cycle. Pretty predictable, right?
So let's put these two side by side, because this is really the core of it. A stock is ownership. A bond is a loan. Stocks have higher risk, which means they also have the potential for higher returns. Bonds, they're the opposite, lower risk and usually lower returns. And that right there tells you exactly what they do in your portfolio. Stocks are for growth and bonds are for stability.
But, and this is important, lower risk does not mean no risk. Bonds do have a couple of things to watch out for. First is default risk. That's the chance the company or government just can't pay you back. To help us figure that out, bonds get credit ratings. A-rated bonds are seen as the safest. The other big one is inflation risk, and this one's a little sneakier.
Let's just walk through a quick example. Imagine you buy a bond and you loan out $1,000 today.
So, you get your interest payments over the years, and 10 years from now, you get your $1,000 back, just like they promised. Awesome! But here's the catch. Because of inflation, the stuff that cost you $1,000 back then now costs $1,300. So even though you got the same number of dollars back, those dollars buy less stuff. Their purchasing power went down. That's inflation risk in a nutshell.
Okay, so this all sounds good, but how do people actually buy stocks and bonds? Most people don't go out and pick them one by one. It's way more common to buy them in bundles, using what's basically the modern investor's toolkit, investment funds.
These bundles are called funds, and the two you'll hear about most are mutual funds and ETFs, which stands for exchange-traded funds. The big difference? Mutual funds are often actively managed. You've got a fund manager trying to pick winners, which can mean higher fees, and they only get priced once at the end of the day. ETFs are usually passive. They just try to copy a market index like the S&P 500. This usually means much lower fees, and you can buy and sell them all day long, just like a single stock.
Okay, so let's zoom out and put all these pieces together. When you boil it all down, it really comes back to that classic relationship between risk and reward.
This quote really nails it. Stocks are generally riskier than bonds. Both can be used to diversify your portfolio. It's all about that balance, right?
You've got the growth engine from stocks and the stable foundation from bonds. And when you put them together in that basket, you can build something really resilient. So we'll leave you with this thought. You get the building blocks now. Ownership versus loans, growth versus stability. The real art of investing is just figuring out the right mix for you. So the question is, how are you going to balance your basket to get where you want to go? Thanks for joining us.